Ladies and gentlemen, good morning and welcome to the Q3 FY23 earnings conference call of Aditya Birla Sun Life Asset Management Company Limited, hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, Mr. Shial.
Yeah, thank you, Michelle, and good morning, everyone. On behalf of InCred Equities, I welcome all to this Aditya Birla Sun Life Asset Management 3Q FY23 earnings conference call. We have along with us Mr. A. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Bogli, Head Investor Relations. We are thankful to the management for allowing us this opportunity. I would now like to hand over to Mr. A. Balasubramanian, Managing Director and CEO of Aditya Birla Sun Life Asset Management, for his opening remarks. Over to you, sir.
Yeah, thank you for the introduction, and good morning to everyone. I hope you all had the opportunity to go through the earnings presentation, which is available on the stock exchanges and our website. Let me, of course, first begin by wishing all of you happy and prosperous New Year as we begin 2023. And let me start with the updates on the economy and mutual fund industry. On the economic front, 2022 was a year of resetting and recalibrating. From the old regime of easy liquidity and extreme low interest rates, 2022 saw one of the fastest and highest interest rate hike cycles. Highest rise in global inflation was accompanied by highest fall in Nasdaq stocks. Erosion in equity value and increase in bond yields resulted in one of the largest mark-to-market losses in the world economy. The US government bond represents an inverted yield curve, with the 10 to 2-year inversion at more than 50 basis points. This indicates risk of sentiment as a result of concerns fueled by recessionary pressures in the US. We recently came out with our annual investment outlook for the year 2023. And as per our research and analysis, we expect inflationary pressures in India to ease based on our expectation of normalization of high food inflation and supply chain. Moreover, the moderation of global inflation will also aid in domestic inflation management, but also mean the pace of rate hikes normalizing. We expect the terminal rate to settle at 6.5% for India in FY23. We expect credit growth to pick up big time, and while urban consumption will continue to drive growth, one can expect a revival of rural consumption from the slowdown seen in 2022. While global headwinds will continue to pose challenges in 2023, India is in a relatively better position with a more domestic demand-driven economy, political stability, increased government spending, supported by robust tax collection, and uptick in private capex boosting investment going ahead. And over a longer term, positive levers in the form of strong political leadership driving pace of reforms, democratic dividend, and China Plus One strategy, domestic manufacturing, and digital push should drive India to become the third largest economy by 2030. With respect to mutual fund industry, during the quarter, the quarterly average assets under management for the Indian mutual fund industry touched 40.25 lakh crore as on December 31, 2022. As against INR of 39 lakh crore as on September 30, 2022, the industry grew by 5% to 38 lakh crores as on from December 31, 2021. In Q3 FY23, the mutual fund industry witnessed some fall in inflows across various equity and ETF schemes on a quarter-on-quarter basis. A significant proportion of the inflows came from small cap, mid cap, sectoral funds, and larger mid cap funds. As on December 2022, the total number of mutual investors stood at 14.29 crores versus 13.99 crores on September 2022, an increase of 2% on quarter-on-quarter basis. Continuous awareness initiatives and SIPs have improved monthly SIP contribution. The overall monthly SIP book was the highest ever, 13,573 crores in December 2022. The total number of SIP counts were about 6.12 crores. The industry witnessed net equity sales of around 1,100 crores, excluding index funds in Q3 FY23. However, there was a reduction in net inflows as compared to the previous quarter, where the net flows were around 14,500 crores. A NFO contributed around 21,000 crores, of which around 8,700 crores had come in equity and rest of it came in fixed income schemes. In general, equity flows have been coming down mainly on account of prevailing interest rate scenario. On account of continuous awareness campaigns by mutual industry, the overall retail concentration in the industry has increased in excess of 57%. However, overall reduction in fixed income assets is also leading to a higher dominance of individual mix to the overall industry AUM. Coming to ABSL AMC performance, ABSL AMC has always been a leading investment manager that has committed working towards financial inclusion, deepening our financial market and development of mutual industry. Therefore, in order to build a business scale and ensuring long-term value for our customers and shareholders, our area of focus are scaling retail franchise and diversified product offerings, expanding geographic reach and strengthening multi-channel distribution network, leveraging digital platforms to deliver best-in-class service. And all of these are driven by strong and robust risk management and governance framework. Our total quarterly average AUM for the quarter ending December 2022 stood at 2.9 lakh to 2,90,000 crores. Our total mutual fund quarterly average AUM was at 2,82,000 crores with a market share of about 7.9% ex-ETF. Our equity fund mutual fund AUM for the December 2022 quarter was at 1,20,000 crores. Our overall equity mix stands at 43%. Customer acquisition remains an integral part of our strategy. We've added about 0.1 million new folios in Q3 FY23, and with this our overall portfolio stood at 80 lakh numbers, 8 million customer base. Our investment performance has been steadily improving under the pro-investing concept that we are currently promoting, such as large cap, flexi cap and balanced advantage fund would remain as a core portfolio of every investor. In addition to this, we also had good performance track record in thematic funds. At the same time, we still have some distance to cover in some of the other key funds which hopefully should help in improving the flows in the coming period. And fixed income dominance continued to remain focus area in current interest rate environment, and we have launched products in the fixed income category to provide solution to our customers. In fact, we had an early mover advantage of launching target maturity funds during the year. Our continuous efforts are in leveraging bouquet of existing products by launching new products to build size and scale. We have been growing our retail franchise over the last few years with a special focus on increasing market share in B30 cities. We have seen a marginal improvement in our B30 market share in this quarter. Building SIP books is our current constant endeavor to ensure customer stickiness and long-term value for investors. We are also creating awareness about the multiple SIP feature that eases the process of investing in multiple schemes as well as acts as an effective tool for goal-based investing. In order to further increase our SIP book, we have launched a turbo SIP linked to the market valuation, Perquisite SIP to target mid-sized corporate employees, Sahavi SIP to target employers to employee, and Sampurna SIP on the lines of Freedom SIP. As a consequence of our monthly SIP, our monthly SIP book increased from 892 crores to about 942 crores as on December 2022. Currently, we have around 32.6 lakh live SIP accounts with us. Our multi-channel market initiative deepen our presence. Our market share has yielded positive results. Virtual relationship manager model has activated 2,200 distributors, and through Sampark, our distributors onboarding initiatives, they have empaneled over 6,500 distributors. Customer loyalty and deeper engagement and service differentiation remains the cornerstone of our service to sales model. Currently, around 230 dedicated trained professionals have been deployed to act as a single point contact for guiding and servicing investors' needs. With respect to our overall mix between retail and institutional customers, 51% of our asset contribution comes from retail investors as of December 2022. The same manner, the contribution from B30 cities also have grown to 17%. Our focus in building retail both in B30 and T30 markets remains integral part of our overall strategy. On the digital front, we continue to collaborate with the fintech partners to increase the overall digital engagement and also its contribution. We onboarded 70% of our new customers digitally. Currently, 85% of the overall transactions are done digitally, and 89% of our customers are now serviced via digital platform. We also empowered 91% of our new MFDs digitally the last 9 months ending December 2022. Passive and alternate asset business. Our passive products offering grew by 4 times to 21,619 crores as on December 2022. our existing passive bouquet has grown to over 35 products, and we have around 5 products in the pipeline to be launched. And the customer base in this category also has grown to around 4,70,000 folios. Also, we are industry leader in debt index fund, which grew by about 24% on quarter-on-quarter and around 5 times on a year-on-year basis. On the PMS and AIF front, we have raised commitment of about 350 crores in India equity service-oriented funds in Q3 FY23 and likely to close this fund by end of March this year. And we also have 4 products in pipeline under AIF to be launched in the next few quarters. On the offshore front, we have been granted approval by International Financial Services Authority, which is the GIFT City, to act as a registered fund management entity in the non-retail side in GIFT City. Prospectus for ESG engagement fund has also been filed, and we got the approval also for launching this fund very soon. On the real estate side, we are collaborating with the Bendel Greenwork, which is Sun Life arm based out of New York, to conduct roadshows for offshore, and soon we will start seeing the impact of this coming in as we start the engagement at the ground level for rising funds. Now moving on to the financial numbers. In Q3 FY23, revenue from operation is at 314 crores versus 311 crores in Q2 FY23. In Q3 FY23, operating profit before tax is at 174 crores versus 173 crores in Q2 FY23. For 9 months ending December 22, revenue from operation is at 930 crores as compared to 969 crores in the 9 months FY2022. Operating profit before tax, excluding extraordinary items, for 9 months ending December 2022 is at 518 crores as compared to 566 crores in the 9 months of FY2022. With this, I would like to conclude and open the floor for any questions that you may have.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Swarnabh Mukherjee from BNK Securities. Please go ahead.
Yeah, thank you for the opportunity, sir, and good morning. So I have 3-4 questions. First one, if you could let us know whether, like we had, there was a comment during last quarter's calls that because interest rates are hardening and we'll get a higher rate on the debt products. So are we able to now garner higher yields on the debt side, or is the fact that our overall revenue level yields are holding up is primarily a change in the asset mix? So wanted your comment on that.
I'll ask Parag to answer this question.
So on the yields are holding up. As you rightly said, one of the reason is our asset mix is slightly getting better towards equity and long duration fund, but it's just a starting. It will take a little time, a couple of quarters, to see a big impact, which we are thinking that once the interest rate get hardened, the duration product will see flows in those schemes.
Sure, sir. So does this mean, yeah.
Just add to this, we have positioned some of our fixed income product. 3 products we already positioned, both for retail as well as for institutional customers. And while we have been promoting it quite continuously, citing opportunity to build a fixed income as an asset class this financial year, the real flows yet to start coming in. Given the fact only now we believe that a peak rate cycle will come in soon, and the portfolio will start reflecting the real outcome that can add to the customers. And therefore, we see a flow coming in from now onwards. But only thing we have kept ourselves positioned to have those products readily available, so that the readiness will ensure that flows are coming in. That's the way we are positioned right now.
Okay, sir, that's great. So, a follow up on this. So, does this mean that, say, for example, the general stance that we see is that we expect in the industry because of the increase in passives as well as what had played out in terms of the commission for the newer flows on the growth oriented side also, that there will be dilution in the yields also going ahead, more a secular trend. But in the near term, so maybe over the next 3-4 quarters, as this what you said it plays out, then should we see some stability in yields for the next 3-4 quarters? Would that be a right assumption?
Yeah. So currently, as you rightly said, equity we may see some dip due to the new asset coming at slightly higher cost compared to the stock. But if the composition of equity goes up and the long duration product goes up in the overall equity AUM, so overall AUM, then we may see a stability in the yield, depending on what mix it plays out over the period.
Sure. So I mean, just to harp on that point a little bit. So if equity also increases in the mix where it is much higher, even at a slightly lower rate than what we had seen earlier, but it is much higher than the blended yield that we have, and also we are able to push in slightly higher yield in that side, then ideally it should stabilize, right? So that's what I wanted to confirm, because both these levers are playing out.
Yeah, I think your assumption is right. I think that should stabilize for the reason I already just explained. And even the fixed income, the actively managed funds also starts growing. That incremental contribution could also come from there. So therefore, these two combinations put together, and with the growing of index fund, which is low margin assets, but still overall we'll be able to maintain at least in the near immediate future.
Great, sir. Bala sir, could you name the products that you mentioned that you have positioned for both retail and institution to capture this higher yield cycle?
Yeah, one is the low duration fund on the 9 to 10 months kind of category. Dynamic bond fund is about 2 to 3 years duration period, and medium term plan again with about 2 to 3 years duration, and credit risk fund, which of course goes down in terms of credit curve to AA minus. This is the 4 funds we are pushing as far as retail concerns. As far as institutional customer concerns, at this point of time, most of the inflows have been coming in the target maturity fund. At the same time, we are positioning ourselves with the elevated yield on the 1 year rates as well as about 2 year rates, right from money market funds to the corporate bond fund. We have position, including floating rate fund, also we have position as far as the corporate concerns. And these are the funds which are identified clearly for both HNIs and retail and corporate. The sufficient push is being given from the positioning point of view.
Okay, sir, very helpful. Sir, now a question on the channel side. What I see over the last 2 quarters, so of course 1Q in terms of AUM, if we look, it will anyways look like a blip because the market was down significantly, so there is an MTM impact. But if I look at Q2 and Q3, what I can see is that a higher share of growth is being borne by the MFDs and the national distributors, while in the bank and the direct channel, the numbers have been tepid. So I wanted to understand, so banks, I believe that, there is also, a lot of variables at play, but in direct, why has particularly in this quarter, the AUM gone down slightly? So if you could comment on what is happening on this side.
I think direct is a combination of the reduction in the fixed income assets. I think we have seen net outflows as far as the actively managed debt fund concerned. I think most of the money have moved to the liquid fund, and some money, of course, which has moved out, I would assume would have gone to the deposits, because deposits during the last quarter priced by banks are also pretty high. I think mainly this is on account of that. But the channel contribution from IFAs is also looking up. I don't think we can attribute to the real incremental growth that had come. It's more of mix of assets would have also tweaked that contribution coming from IFAs. But the direct is mainly the reason I just mentioned.
Okay, sir. So even in the equity sourcing numbers that you provide in the presentation, I think there is a slight dip in direct this quarter. So that is why, that was my question.
So it is not major. It's a slight dip in direct compared to MFD, because there may be some movement which has happened in the direct AUM institutional customers, and there may be some movement on the MFD side of higher share of the sales which has happened. But there is a very small movement which has happened.
Got it, sir. Yeah, very, very helpful. Just two bookkeeping questions. One is if you could, tell me the reason why the fees and commission expense was slightly higher this quarter. And second is if you could share the SIP AUM number at the end of the quarter. Thank you.
SIP AUM is 57,000.
Okay. And on the fees and commission, sir?
Swarnam is 53,000.
53,000. Okay.
And the fees and commission has gone up slightly because we have launched a new AIF product in the current quarter for which we collected 350 odd crore of commitment, on which the brokerage which we have given or commission which we have paid out, that has been sitting in that line.
Okay, sir. So this won't be a recurring number, right? So this is a one-off?
No, it will be a recurring because it's more of a trail which gets paid.
Okay, got it. Thank you so much, sir, for the detailed explanations and all the very best.
Yeah,
thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may please press star and 1 now. We have next question from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity. So, sir, just have one question. So, while there has been an increase in the...
we are not able to understand what you are speaking. I would request you to keep your mic a little bit farther from your mouth and speak, please.
Yeah, am I audible?
Yes, please proceed.
Yeah, so just I had a question on the SIP inflows. So, while there has been an increase in the absolute inflows, but seems like we have lost some market share also in the inflows as well as in the newer registrations also. So just wanted to understand how are we positioning ourselves to recoup some of this lost market share? Wanted your comments on the same.
Yeah. I think thanks, Lalit, for this question. In terms of the SIP flows, what you have understood on the basis of the analysis, the large SIPs, incremental subscriptions have gone into the funds which are outside the Nifty and Nifty 50. Basically, one more towards small and mid cap, and to some extent on the large and mid cap, which is what I think I've seen in flows. In our case, of course, these three funds generally did not receive as much of flows that we should have received. But most of the flows for us, the registrations have come into the existing the flagship funds. But from an industry point of view, the large flows have, whatever the increment flows have come into this. That's the primary reason because of which our registration rates were marginally low. Though industry also has seen a reduction in the registration and compared to the overall basis. But in our case, this was the primary attribution. That's something which I just mentioned in my speech as well, that there are a few funds where we have to catch up with respect to the performance. We have to cover some distance. I think once it's done, then the positioning could also happen. And second, we also launched few of SIPs to like Turbo SIP I just mentioned about. We also launched a few other new SIPs as a product, and is being driven the entire distribution community as well as the sales team to bring in some kind of higher traction, some of the newly launched features in the SIP side.
Sure, sir. And so, in your earlier comment, you mentioned that there have been some outflows in the fixed income funds where the funds are being slightly moving towards the deposit sides due to the higher rates being offered by the banks. So, how long do you think that this trend could continue in the future? And since when do we expect that we can get a good share of inflows in the debt side?
I think the way we see is while it will be difficult to actually predict how far the banks will be aggressive in terms of rising deposits, given the high credit deposit ratio, which is more in the range of about, the growth is about 30%, 130%, sorry. That being the case, and our own belief is this may at least carry on for at least this year till March ending. At the same time, we also believe that as the credit demand continues to rise, we will probably see marginal uptick in the yields, especially for the spreads widening. And that's the time the risk-reward ratio, including adjusted for the tax benefit, the mutual fund would become more attractive once the rate stabilizes, which is what we believe, that once the rate stabilizes, I think there will be stability both in the deposit rates which is being offered by banks as well as the lending rate, and the market rate stabilizes, then mutual fund will become more attractive compared to the other fixed income instruments. So that we believe that could happen in the 2023 second quarter onwards.
Sure. Thank you, sir.
Thank you. Before we take the next question, a reminder to all the participants, you may press star and 1 to ask a question. We have the next question from the line of Prayesh Jain from Motilal Oswal Financial Services. Please go ahead.
Yeah, good morning, sir. So just a few questions. Firstly, in December, the SEBI had come out with a press release with regards to reconsideration of all the fee structure and all the other expenses that the AMC charge. And I think additionally, yesterday there were some media articles which have kind of outlined some contours which the SEBI is kind of considering, wherein they're talking about capping the TERs at the scheme category level, and also subsuming the GST and the brokerages which are out of the TER currently into the TER. So your thoughts there as to whether what kind of things the SEBI is considering, or how this could pan out, and how could really this impact the yields for you guys if such things are being brought across? That would be my first question.
Yeah, sure. Thanks, Prayesh, for this question. Of course, there is a deliberation within SEBI, and SEBI always drives this decision through the MF Advisory Council, which is set up for the development of mutual fund industry. In fact, I'm also part of the member of the MF Advisory Council. The deliberation has been how the investors can benefit in the form of reduction expenses, which basically are coming from the fact that industry has been growing steadily each year. Now it has reached about 40 lakh crore size. Some bit of scale benefit should come to the investors. And at the same time, the overall AMC growth should continue to be the driver of the Indian economy. And these two aspects, they of course have in their mind. There is a deliberation, and in order to relook at the current expense structure and look at the merit, whether it can be further reduced. At the same time, the industry continues to add more customer base and go to the next level of growth. The way I see is an as-it-is basis, assuming scenario that we go by what they are saying, then there of course there will be need to look at the cost structure on the one side and an operating model on the other side. At the same time, focus on volume. The way so far we have built the last almost 7-8 years, despite the fall in the expenses, as you would have seen the glide path which was given in the year 2018, higher the AUM, lower the expenses. And despite living in that kind of scenario, the AMCs have been able to adjust and continue to build a scale, continue to build the expansion. At the same time, generate absolute profit, which could be which is the free cash flow generation that they do, and also bring an absolute profit to growth that they bring in, which largely coming on the back of the scale benefit. So that's the way I'll see it. What extent the reduction in margins could come at this point of time, very difficult to gauge. Given the fact that whatever is being discussed, it is just a deliberation, and industry has been making a representation, the need for industry growth to go to the next level, the need for distribution expansion, and increase in further growth in equity AUM in order to give more stability to the capital market. given the fact the FPI is going to continue to remain a seller in the market. All these representations are being done. And till such time the debate happens, the discussion happens, very difficult to come to any conclusion at this point of time how it could impact. Any reduction that comes, of course, the operating model also need to be suitably looked at to ensure that they remain profitable in terms of absolute growth and absolute profit increase. Maybe the time will come, we may have to actually measure the success on the basis of the absolute profit that is being on the table rather than basis point contribution.
Bala sir, in this context, if we look at, so this, if something of this sort is implemented, this would mean two things. One, reduction in distribution commissions. Secondly, this could also impact the AMC yields. So in a way, this doesn't this kind of, go against the philosophy of expanding the reach, especially in the current scenario where we want to enhance the reach in the B30 and deeper penetration of financial products? Doesn't if distributor commissions are kind of impacted further, then why would the distributor be keen to distribute these products further? And especially on the competitive product, if you look at the insurance sector, we've seen that the expense of management ratio is kind of being completely getting deregulated, wherein they're just capping the 30% expense of management and the commissions could go higher as well going ahead. So in that sense, the competitive products will get better commissions. So what incentivizes the distributor to sell mutual fund products over other products?
Sure. Now that is a representation, that is a discussion is on, Prayesh. As you rightly pointed out, the industry still needs to grow bigger, and mutual funds gained significant prominence, and under which we have now grown to wherever we are today in terms of size, 40 lakh crore size, 20 lakh crore in equity size. We still have a long way to go with respect to the penetration. I think the point that you exactly mentioned, this is which the discussion also is happening. That's why it's too early to make an assumption that I think the regulation also would definitely respect the need for the growth and need for expansion of B30 market or maybe deeper penetration in the country. The need for distribution expansion also happened, given the fact we as an industry body have gone and encouraged more and more people to join the distribution community, and we also encourage them under the guidance of regulator. So keeping all this in mind, I'm sure the representation or the viewpoint that is coming from people would also be taken into account before the company conclusion. So that's why too early to right now say that it'll get pushed through. I'm only hoping that whatever the points that you mentioned, which we also of course echoed as industry players, hopefully get listened and then they take suitable action accordingly.
And sir, if you can help us with some understanding as to segment-wise, what could be the EBITDA as BIPs for us as an AMC, say, broadly, it's not very specific, but equity, what kind of EBITDA in terms of BIPs we will be earning, and debt and liquid and others. That would be helpful.
Sure. Parag is just taking this question.
Yeah. So, Prayesh, as the contribution we monitor at the overall at the asset class level. So equity more or less in the range of 70 basis, liquid is in around 11-12 basis, and debt is in the range of around 25 to 28 basis.
Yeah, that's helpful. So if we look at the salary expenses and the cost, what would be the respective EBITDA and BIPs in these segments?
So we don't disclose these numbers, but basically equity is more of a retail and oriented product. So it will have a lot of sales push which will be allocated to that. But there is no specific number which we disclose on this.
Yeah, I understand. But honestly, while most of the expenses will be sitting on the scheme. So on the AMC books, it will be ideally the fund manager and the research team charges, right? So can you just, even for the equity segment, what kind of EBITDA spread EBITDA could be making? Could you give that indicatively out of the 70 bits?
It will be more or less in the similar range for EBITDA which we are currently generating in the proportion. So it will be similar. I don't have the numbers currently, and even it is more or in the same range should be.
All right. Thank you so much and wish you guys all the best.
Thank you. Participants, you may press star and 1 to ask a question at this time. We have the next question from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi. Good. Just 2-3 questions from my side. One, if you can just, one is a data keeping question. If you can just give your employee count for the quarter. Second, if you can split your revenues into domestic mutual fund revenues and PMS and others for the quarter and 9 months. And third, in terms of your alternatives, now you have a strong product lined up, product pipeline. Just wanted to get some sense of the medium-term targets in terms of commission revenues or EBITDA level, and also what kind of incremental costs that you really incur in getting this part of the business up and going.
I'll just take the last question first, then I'll just get the number of employees. 1,400, is it?
1450.
1450 is the total employee count. And I think the respect to the AIF pipeline, we as I mentioned, Service Opportunity Fund, we have been running for the last almost 6 months, rather 4 months. We'll be closing in the month of March ending this year, 2023. We already done about 350 crores and incremental collections are still awaited. Once this is closed, we have kept 3 more products on the pipeline. Again, on the equity-oriented funds, and then we will launch those funds immediately after that. We also kept 1 AIF on the fixed income space, mainly taking into account the opportunity that we see on the credit side and a customized product that also we intend to do. And then third AIF is around the real estate. Having now raised about the current size of about 550 crores in real estate fund, we have been seeing one deployment of money leading to a better result from the experience point of view. At the same time, we're also building a pipeline for launching one more product on the real estate side. So this is the pipeline that we have, and all put together, we'll be launching it as we see opportune time for each of these segments that we are identifying. What's your second question?
No, so just so one was if you can split your revenues into PMS and mutual funds, and just to follow up on this part, would you like to give some color on your medium-term targets in terms of revenue or profitability coming from the alternatives? I mean the non-mutual fund side of the business.
Sure. Revenue contribution. Yeah.
So Dipanjan, our revenue contribution from the PMS and other alternate assets is in the range of around 50-55 crores for 9 months.
Sure.
Yeah. In terms of outlook on this segment, so right now, having had the team and having now launched, and our idea would be to launch continuously to ensure the size gets built. As you know, in the AIF space, the money is paid upfront, but the revenue comes as the time progresses. So that is the we'll do it. Therefore, as Parag mentioned earlier, to the extent we may have to spend that money to build the future profitability. And that's the model in which we'll be running it. Though I don't have the right now number to give, but clear plan that we have is a product pipeline and the experience that we are creating the existing product that has been launched would help us in increasing our share, and for which including fixed income schemes for which we are already getting our product in pipeline.
Sure. Just one point. So if I heard the employee number correctly, it was around 1450, which seems almost net addition of around 100 employees quarter on quarter. So where is this employees really getting deployed? Is it on the MS side or or just building up on the alternative side of the business?
2-3 areas. One is the direct HNIs model we are building in. We have almost about 20-member team. We build it only for Mumbai and Delhi, and we'll expand this as we start seeing the success in this model. Second, we also added more people on the service side, customer service side, especially in the service to sales RM. And third is the VRM, where we have set up a separate VRM cell to increase the number of connects to the people. And last, of course, is on the retail sales side, and increase number of customers. As for the investment concerns, we added about our analysts. We added about 2-3 more analysts. We have added, especially the mid cap, small cap analyst. But those are, of course, 1 or 2 member addition, both in the AF side as well as on the mutual fund side.
Got it. Thank you, and all the best.
Yeah, thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question at this time. We have the next question from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Hi, good morning. Bala sir, just going back to the question on regulations again. So the last round we had, the revision was like in 2019 itself, right? And the regulator is now wanting to have a relook at it again. And going by what we currently have, it's already like the current framework itself builds some scale benefits to be passed on to the customer, right? So, like, what is the regulator worried about that they have to kind of have a relook at it again? And secondly, from an industry point of view, is there a way to sort of have a let's say more fair distribution between the AMCs as well as the distributors going ahead? Is there a more permanent model that can be worked out, which kind of protects your margins as well on an ongoing basis?
Yeah. Sure, Abhijit. I think the first year, the assumption that under which normally the review, I think when I go back in the history, 2012 was the first circular, then they revisited in the 2015, then they revisited in 2018 and 2019, both the times they revisited. After every 5 years or 3 years, I think they seem to be thinking that there is a merit for them to revisit. If there is a merit for them to consider any reduction expenses with respect to giving investors benefit. That's the primary objective assumption on which they are coming. Second is, I think in the last few years, as that is known, for a variety of reasons, the active managed funds would not have been on the benchmark, which is of course not just India kind of scenario, even global scenario. And we also know, of course, for a variety of reasons, the money manager could not beat the benchmark, more from the point of view of risk of owning certain stocks which are heavily overweighted in the index and so on and so forth from risk management perspectives. And that's something also is making them think, is there any merit for that to be cut down? So this is coming from these assumptions only. As I mentioned earlier, these are the deliberation and not necessarily what is being currently assumed would come. Of course, we also cannot rule out any marginal changes also coming in after multiple round of discussion. That's what normally they do, more of evaluation process that they have, evolving decisions in the consulting industry. So let us wait for that. As far as the cost concerns, naturally, if this is going to be continuous in terms of reduction of expenses, in terms of TER, then naturally the cost structure also need to be relooked at both at the distribution level as well as the other costs involved also need to be revisited. And that's something my own belief is will evolve as we move ahead gradually. At the same time, keeping in mind the real need for distribution expansion to happen. More and more people should join the mutual fund industries to distribute mutual fund product. Therefore, help the industry to grow on one side. At the same time, build other alternates such as the direct in order to reaching out to the customers also on the other side. I think all will have to go hand in hand and keeping in mind the growth needs. At the same time, be conscious about the cost element that all of us as an AMC have to also pay attention to it. I think that's something which my own belief is will evolve.
Got it, sir.
Yeah.
Sure, this is helpful. Thanks a lot.
Yeah, thanks, Abhijit.
Thank you. We have the next follow-up question from the line of Prayesh Jain from Motilal Oswal Financial Services. Please go ahead.
Yeah, hi. Thanks for this opportunity again. So just on this regulation bit again. So what are the current brokerage roughly being paid on the equity and the debt side and also the GST rates?
Talking about market transaction?
Yeah, for the transactions, what would be the brokerage that would be paying to the broking companies?
Roughly in the range of about 10 basis points roughly. Yeah, 8 basis points.
So 8 on the equity side and derivatives in the range of 4 or 5.
Yeah.
Okay, and what would be that cost on the debt side?
Debt is very minimal, Prayesh. Yeah. Debt is insignificant actually. It will not even come into the 4 decimals of basis points.
Oh, okay. And what about the GST rate?
GST is applicable, right? Not GST, STT is here.
Are you talking about STT or GST? GST
will
be, so GST will be on the, depending on the scheme, so 18% of the fees. So if it's 71 basis for this thing, it will be in the 18% of it.
18% of the fees. Okay.
And it's wonderfully GST.
Okay. And secondly, so if you think about the debt schemes, there has been a significant increase in flows towards the passive category as well over the longer duration side, right? So how do you see this eventually, even when the cycle picks up, do you think that the flows will be towards the passive categories only, or do you think that the active can see further improvement in flows?
No, the way we see is there will be a switch from target maturity funds. Of course, target maturity will continue to grow given the fact it has the element of certainty on return expectation. In fact, even target maturity fund also we all are aligned to the minimum expenses that we are also charging. Therefore, it is not something non-profitable per se, like a liquid fund where you get about 20 basis points. The same thing that has been being followed in the target maturity fund as well, in order to be fair to both investors and even from AMC point of view. While that being the case, we believe that some bit of more acceptance will come for the duration funds. In the duration funds, we don't have a restriction in terms of we'll buy only in GSEC and SGS or AAA. Whereas target maturity fund, there will be restriction in terms of investing only in the AAA names or PSUs and SGLs and GSECs, whereas that is not the case as far as the open-ended fund concerned. Also keeping in mind, as you go down the credit curve, even to AA+, the pickup in yields will be in the range of about 30-40 basis points, which nobody would like to ignore, given the fact a basis points add to the overall return as on the fixed income concerns. That's why we believe that more participation could come from the HNIs and retail, and in the actively managed duration funds in the range of about 2 to 3 years or 2 to 4 years.
All right, that's helpful. Thank you so much.
Thank you. As that was the last question for today, I would now like to hand the conference over to Mr. E. Balasubramanian for closing comments. Over to you, sir.
And thank you very much, ladies and gentlemen, for tuning in. And with this, we conclude our Q3 and 9-month FY23 earnings call. Do feel free to reach out to our IR, Mr. Prakash Gokhale, for any queries that we may have. And thank you and have a nice weekend.
Thank you, sir. Ladies and gentlemen, on behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.